Okay, here we're going to be looking at the consolidated statement of cash flows here, and we're going to look at what we have to disclose here for a non-cash acquisition here for controlling interest here, and it's going to be as an investing activity here. So for example here, Corporation P, the parent, buys 80% here of Corporation S, the subsidiary, for $1,080,000, and they're not going to pay cash. What they're going to do is they're going to issue stock here to Corporation S, the subcorporation S, for their purchase here of subcorporation S. So there's several things that we have to do here. We have to make a disclosure here of the purchase of subcorporation S here on the consolidated statement of cash flows, and then we also have to have a supplemental schedule here for the non-cash financing and investing activities involved in this acquisition here. So we'll just go into it briefly here on how we'd make our calculations here for these disclosures and what would have to be disclosed. Okay, for example here, Corporation P, the parent, issues 20,000 shares of their stock here, valued at $54 per share, the market value here. So taking 20,000 times $54 per share, that equals $1,080,000. That's what they issued here to subcorporation S to buy 80% interest in subcorporation S. So based on that here, the implied fair value of subcorporation S would be the $1,080,000 divided by 80% here, or would be $1,350,000. So the next thing we have to do is we have to go over to the subcorporation S's or the sub's balance sheet here and compare the book value with the fair value here. Now doing that here for our assets, you can see we had some adjustments here in the equipment and the building. They increased here, and the liabilities over here stayed the same. So looking at our adjustments down here, we have adjustments to our assets here. We have an equipment adjustment, a building adjustment, and we also have a goodwill adjustment here, and that's what we're going to have to calculate here. So we had, in this case, total adjustments here of $250,000. Now that includes the goodwill. So let's go up here and look at how we calculate that goodwill here. So going over here to our looking at our fair value of our net assets, first we have to calculate that here. So our total assets here at their fair value here was $1,570,000, and then the total liabilities here at their fair value were $300,000. So going, our fair value of our net assets would be the difference between the $1,570,000 here in assets less $300,000 here in the total liabilities. That gives our fair value of net assets here at $1,270,000. So with our implied price here of $1,350,000 less the fair value of our net assets at $1,270,000, we have goodwill here of $80,000. So we've accounted for our total adjustments here, going over to our adjustment sheets here that we have, and that would be the excess of the fair value over the book value here of $250,000. Now the next thing we have to go is we have to look at a value analysis here looking at that, down here we have Corporation S, their fair value. We determined the total amount here was $1,350,000 less the parent portion here of 80%, which they paid, the price they paid here of $1,080,000. So the difference here would be going to the non-controlling interest here, the subcorporation S here, for $270,000 because they have a 20% interest here. Now the next thing we have to do is we have to go down here to, we based on that we can calculate our goodwill here too. So fair value, subcorporation S's fair value of $1,350,000 less the fair value of the net assets here of $1,270,000 gives us that goodwill here of $80,000. Now the next thing here for our distribution schedule here, going down to that, and we'll only look at the total amounts here. So the fair value of the subsidiary was $1,350,000 here less the book value acquired here. That was $400,000 up here. Going up to our balance sheet here, they're going to get the common stock here $400,000 plus retained earnings here of $700,000. So the total equity in this case would be the common stock plus the retained earnings here, or the book value of the total equity, $1,100,000. And of course that would be divided up here and then between the parent and the non-controlling interest. And we can go through that here. But the difference here, the excess of fair value over the book value, would be the fair value of the subsidiary, $1,350,000, less the total equity here of $1,100,000. So total excess fair value over the book value here was $250,000. Divided up here between the parent, of the $1,100,000 in equity, they would get $880,000, and then the subsidiary would get $220,000. And just taking the difference here between their fair value apportioned out between the parent here and the non-controlling interest, you divide up your fair value over your book value here, $200,000 to the parent and $50,000 here to the non-controlling interest. So we've calculated here our excess of the fair value over the book value here, both on our distribution schedule here as well as on our asset adjustment that we have to make here for our total asset adjustments. All right, now let's look at what has to be disclosed here on the consolidated cash flow statement here for the acquisition here, or the non-cash acquisition here of the subcorporation S by the parent. First, looking at the cash flows from investing activities for the consolidated cash flow statement. We'd have to include the cash acquired here in the purchase of subcorporation S, and that was $100,000 here, and that was off their corporation S's, subcorporation S's balance sheet here. The cash amount was $100,000. And then we'd have another section, or a supplemental section here, a supplemental schedule here, and that would be for non-cash financing and investing activities. And we'd have to include the adjustment of the value of the assets acquired here of $1,400,000 book value plus the $250,000 excess here for a total amount of $1,650,000. So let's look at where we've got this. The $1,400,000, that comes off the corporation S's balance sheet here at their book value of $1,400,000, and then we have this excess here of $250,000. Now that would either come off our distribution schedule over here, that would be the fair value of the subsidiary of $1,350,000 less the total equity acquired here of the subsidiary, $1,100,000, and that was the excess of fair value of the book value here of $250,000. That could have also came off our adjustments accounts here for the equipment, the building, and the goodwill, total amount here of $250,000. So we've taken care of that. Next, we'd have to look at the include here the common stock issue. That was a common stock that the parent corporation issued, their common stock that they issued to the subsidiary here for $1,080,000, and that was based on the market price and the number of shares here that they issued. The next thing we'd have to include here is the liabilities assumed here, the liabilities of subcorporation S assumed here, and that comes off the subcorporation S's here balance sheet here. Total liabilities, the fair value would have been $300,000. And then the next thing that we have to include here would be the non-controlling interest here, and that was, we determined that to be $270,000 here, and that comes off our distribution schedule here, where the fair value of the subsidiary was $1,350,000, and then it was proportioned out here. The parent got 80% of that, and then the non-controlling interest would get 20%, or $270,000. So this is what would have to be disclosed here in our consolidated cash flow statement here for this non-cash purchase here of the subsidiary.